The Federal Reserve is probably going to crash the stock market. Even permabulls like Tom Lee, he is concerned that the Fed is going to crash the stock market too. So I'm going to play a quick little interview with Tom Lee right now. After that, we're going to go to my $947,000 account. Here we go.
The 10-year yield touching its highest level since April earlier today. But our next guest says the rise in yields could be a false flag. Let's bring in Fundstrat Head of Research and Fundstrat Capital CIO, Tom Lee. He's also a CNBC contributor. Tom, good to see you. Okay, so let's start there with the yield impact. What might people be reading wrong, you think?
Well, I wouldn't say markets are necessarily reading it wrong, but I would say as uncomfortable as we are seeing yields at near one-year highs, I don't think that this is going to be the level we see a few months from now. And I think that's more important because ultimately, if yields begin to fall because inflation pressures are easing, or if the job market is a bit softer than expected, it really puts the Fed back in focus. So I guess what I would just say is it's not comfortable to be here at where yields are. I don't think it really breaks markets, but I don't think yields are necessarily moving higher over the next few months.
Well, it's particularly uncomfortable, arguably, for small caps. Early last year, probably around this time, you made a bold call on how much small caps could rise. You've moderated from that since. But where do you see small caps going now? Why didn't the big pop that you projected for 24 pan out?
Yeah, small caps have been disappointing. I mean, unfortunately, I think there's been a rug pull on those names a few times. So I think investors are going to be very wary. But to us, I think the roadmap for 2025 is still one where the opportunity for stocks to have much better breadth widens, because not only do we have an incoming administration that is pro-business, and I think it is going to boost CEO confidence. It's pretty evident now, even seeing it in both ISM readings recently. But that's going to be a better environment for mergers. So to me, while small caps have been big laggards, actually for the last 10 years, this 10-year underperformance to the S&P is the worst in actually almost 100 years. So second only to 1998. And then from a valuation perspective, small caps are still much more attractively valued. The median PE is around 11 times, and that's almost 7.7 turns cheaper than the S&P. So it's been tough, John, to be overweight small caps, but I think they're going to work in 2025.
So Tom Lee is basically saying this huge rally that we're seeing right here in a 10-year Treasury bond basically went from 3.6% all the way up to 4.6%. And what's very interesting is in the same time period right here, as these yields are going up, the Federal Reserve is actually cutting interest rates in the same time period right here. So we went up by 1% right here, but the Fed actually cut interest rates by 1% right here too. And I do think this is actually really, really concerning, because the stock market and the bond market is not really believing the interest rates are going to go lower. Inflation expectations are going higher. So when inflation expectations go higher, the Federal Reserve is probably going to keep interest rates higher for longer, assuming that inflation stays higher too. But there's a massive, massive problem with that. And the problem with that is that we could potentially go into a big recession. So the Federal Reserve is always in this balancing act of keeping interest rates higher for longer to make inflation go down. But if you stay high for too long, you could potentially throw the US economy into a recession. So looking at this chart right here, you could see that June of 2022, our inflation was 9.1%. Yeah, it was crazy high. COVID happened right here, and then inflation went straight up. So then the Fed started to tighten interest rates, and that brought our inflation all the way down from 9.1% to now we're in this range right here, which is 2.7%. The problem is we're starting to be sticky around this 2.7% level, and you can see right here this little spike up right here. There is data that's been coming out recently that is pointing to more inflation. Now the problem is the Fed is planning to stay higher for longer as long as they can to keep inflation at bay as good as they can. But the problem is that the economy is also showing signs of weakness. The total number of unemployed people are going up. The yearly salaries that people get year over year, they're not going up as much. And the reason why is because employers don't have to raise the salaries to attract new employees. Employees know that the economy is not as strong as it was maybe a year or two ago. So employees are more willing to stay at their current job because they're less confident they can find another job out there in the economy. So there's a lot of conflicting data going on right now. And the Fed is in this balancing act of trying to figure out, do we go higher for longer or do we cut interest rates at the cost of maybe having higher inflation? Now you're probably wondering, like, Brandon, why does this matter for my portfolio? And this is the reason why. So this right here is a 5-year chart of the NASDAQ index. Triple Q is the ticker. This is the one that tracks the NASDAQ. So the reason why interest rates matter so much, Warren Buffett says it, every famous investor in the world knows interest rates are like gravity on the stock market. So this was COVID right here. The stock market was pumping pretty much since COVID right here because interest rates were pretty much at 0%. Now, once inflation started to get out of control somewhere in the end of 2021, the Fed said we're going to start raising interest rates. So the triple Q went from 403 all the way down to 268. So that's roughly a 35% drop in this period right here because the Fed was raising interest rates from 4% to pretty much 5%. It's a 5% interest rate increase. So that is really big. And as interest rates go higher, there becomes competition with stocks in the bond market. So ask yourself this question right here. If the stock market historically does 10% every single year in the long run, some years it'll be 40% up, some years it'll be 40% down, but in the long run, we should expect roughly 10% per year in the stock market. That's what history shows for the last 60 years. Look at the 5-year return on the NASDAQ right here, 135%. So the market went up way more than 10% per year in the last 5 years because this will be somewhere around 50%. It'll be a little bit more because of compound interest. But long story short, the market went up way more than what historically it does. So that is a concern for the market that it is potentially overvalued. Now, if we have an overvalued stock market at a time that interest rates might stay higher for longer, we are setting ourselves up for another dip that could happen like this right here. So this is why I say it all the time, to only make plays with high margin of safety. Don't over leverage right now. You want to be really, really careful out there right now because right here, maybe this was the top. Nobody knows for sure, but I promise you that inflation spikes higher and the Fed happens to stay higher for longer, or even if they raise interest rates, the stock market will make a correction lower because rates are gravity on the stock market. Because if you could get a risky 10% return in the stock market where it's going to bounce up and down like crazy, and keep in mind it went up way more than 10% in the last 5 years, so maybe it's due for a pullback down, or you could go over here and grab this bond and get a guaranteed 4.68% with no risk. This is pretty much a guaranteed rate of return because this is guaranteed by the United States. So if the United States fails, this will fail, but then we'll have bigger problems in the stock market anyways at that point. So 4.7% or risky 10% when the market might want to pull back. So the Federal Reserve did just release their minutes from the December of 2024 meeting, and they were basically talking about staying higher for longer because they are more concerned about this little bump in inflation than what most people think they are. They don't want to lower interest rates too fast, and then this happens to go spike way higher on top of the uncertainties with the Trump administration. Who knows what Trump is going to do? Maybe he puts in tariffs, and tariffs could be inflationary in the short term. So that could make upward inflation pressure right here. And then the Fed might even have to raise rates going forward. So the Fed is going to trend carefully. They're only expecting a few interest rate cuts for 2025. It's only projecting one cut right now. I do think there's going to be more than one cut, and I'm going to show you why. But this chart right here is just showing you the history of interest rates since 1955. They went way up all the way into the 80s, and then they came down to this period right here. So historically right here, we are kind of low, and we are expected to go a little bit lower, but it's going to be a function of what is going to happen with interest rates. If interest rates go down and we have a strong economy, I do think the stock market could go higher. But if interest rates stay higher for longer, or they even go up, I think there is going to be a lot of downward pressure on the stock market, and I would expect to see a pullback. So you can look at the CME Fed Watch tool right here, and this is essentially just showing you how many interest rate cuts we are expecting to get at the next meeting. So I plugged it in for the December 10th meeting of 2025, and you could see right here the most likely scenario is going to be from 4% to 4.25%. We're currently at 4.25 to 4.5, so this is saying the most likely scenario at the December of 2025 meeting is going to be 25 basis points lower than what we're at right now. 25 basis points is 0.25% lower. So only one interest rate cut is priced into the stock market. And I know you're probably going to be like, well, why do I care about that? And this is why. So I said right here, I think we have one main negative in the stock market right now, which is valuations. I've been saying it for a while now that valuations are a little bit high. And there's one main positive though, and this is a positive that could change your entire portfolio. The market is pricing in less cuts versus what I think is going to actually happen. So you can see right here, we're projecting one 25 basis point interest rate cut for all of 2025 right now. Now, I'm in the camp that this little bump that happened right here on inflation is just a little bump in the road. It's not going to go straight down every single month. I mean, you can see right here, we came all the way down, bumped up, bumped around for a little bit, and then we had this drop right here. Little bump, and then I expect to fall down as time goes on. So I feel like as the data comes out for CPI, which is inflation data over the coming months, I think that data is going to start to come in a little bit soft. I think the economy is weakening a little bit, but the economy is still strong. And I think that the CME Fed watch tool and the market is going to start to price in a chance of having more interest rate cuts. Now, when more interest rate cuts are going to be priced into the market, you can see what happened right here, how the market pretty much went on a pump cycle from the end of 2022 till currently. So I think this is setting us up for upside in the stock market as long as the economy stays strong and as long as inflation stays low. So at the end of the day, do not make plays just to make plays. Only make plays with a high margin of safety. When I do stock options, how I make like $30,000 every single month, how I'm scaling multiple portfolios right now. The one that I showed you guys earlier, that's only one of my accounts right there. I have multiple accounts, but you only want to make plays that you have a high margin of safety on. Do not buy something just because the price is going up. You got to understand what you're buying and at what valuation level. So continue to dollar cost average into quality stocks and ETFs when you're getting in at a good price level. And when you find companies that are trading below intrinsic value, use stock options to magnify your returns. That is the name of the game. That's how I built millions and millions of dollars in the last 5 years in the stock market. You guys could do it too. Do my course below. It's 60% off right now. Prices are going to go up soon. But if you don't want to do my course just yet, watch this video right here. It's going to walk you through how I do stock options on a very basic level. I'll see you guys there.